In life, there may be times when we need financial assistance to achieve our goals or to tide us over difficult periods. In such situations, we may consider taking out a loan from a bank or financial institution. Loans can be broadly classified into two categories: secured loans and unsecured loans. Secured loans are backed by collateral while unsecured loans are not. In this video, we will explore the differences between secured and unsecured loans and the advantages and disadvantages of each type. Let's consider a small story to illustrate the difference between secured and unsecured loans. John wants to buy a car and needs a loan to finance the purchase. He approaches his bank and applies for a loan. The bank offers him two options: a secured loan or an unsecured loan. In the case of a secured loan, John would have to provide collateral in the form of his house or any other asset of significant value. This collateral acts as a security for the bank, and if John is unable to repay the loan, the bank can seize the collateral to recover its money. On the other hand, an unsecured loan does not require collateral. The bank would assess John's creditworthiness and would offer him the loan based on his credit score and income. However, unsecured loans generally have higher interest rates as they pose a higher risk to the lender. John opts for the secured loan as he is confident that he can repay the loan and does not want to pay a higher interest rate. One of the biggest advantages of secured loans is that they offer lower interest rates compared to unsecured loans. This is because the collateral provides security to the lender, and hence, they are willing to offer lower interest rates. Another advantage is that secured loans can be used to borrow larger amounts of money. Since the lender has the security of the collateral, they are more willing to lend a higher amount. The biggest disadvantage of secured loans is that they require collateral, which can be seized if the borrower is unable to repay the loan. This can be a risk for the borrower, especially if they have used their house or any other significant asset as collateral. Another disadvantage is that the loan process for secured loans can be more complicated and time-consuming, as the lender must assess the value of the collateral before approving the loan. One of the biggest advantages of unsecured loans is that they do not require collateral. This means that the borrower does not have to risk losing their assets in the event of non-payment. Another advantage is that the loan process for unsecured loans is generally faster and less complicated than secured loans. The biggest disadvantage of unsecured loans is that they come with higher interest rates compared to secured loans. This is because the lender is taking a higher risk by lending money without any collateral. Another disadvantage is that unsecured loans are typically for smaller amounts compared to secured loans, as the lender is not willing to take on a higher risk. In conclusion, secured and unsecured loans both have their advantages and disadvantages. The choice of loan depends on a borrower's financial situation and their risk appetite. Secured loans are generally preferred for larger amounts and lower interest rates, while unsecured loans are preferred for smaller amounts and faster loan processing. Before taking out any loan, it is essential to assess one's financial situation and to choose a loan that is suitable for their needs. If you like it, click on the like button, subscribe and comment.